Anyway, let's get cracking on to what's coming up today. There's my notes. Right, starting in China, PBOC kept their 1 year LPR. Sorry, I'm in a tizzy now. Kept their 1 year MLF unchanged. That's the one I was looking for at 2.5%, largely as expected. So no movement on that rate at the moment. Don't know where it is on that calendar. Not showing up. What else we've had from China is news that they're apparently looking at, or the government is going to be buying up all unsold homes to ease the amount of properties they've got sitting around doing nothing. As we've noted previously with China, if they have a problem, they can just throw cash at it, and they've got the ammo and the tools to fix that problem, usually by throwing a lot of money at it. So they're going to be buying up a lot of unsold homes, which helps, obviously, the developers, all those in trouble. Obviously, they'll probably get them at mates rates, shall we call it, steep discount, but at least it will keep the money flowing through the system, and some of those firms not going pop and being able to pay back on their bonds and whatnot that they've all been getting in trouble with. So that's some support that China's giving through. Over in Australia, we had some wages data for the first quarter, a little softer on the quarter than expected, a touch softer year on year than expected, 4.1%, but still well up over the previous quarter. So still some wage pressures filtering through there for the Aussies. Aussie related news as well. Look at the price, a bit more detail, but copper hit a record high in New York. The press saying that shorts are facing a squeeze. It's always the shorts facing a squeeze. It's never longs getting longer. It's always shorts getting shorter, and or getting less short and getting squeezed out. Always amazes me when the market goes up. It's always a short. You never see longs getting squeezed, only shorts. But anyway, copper's continue on the up, and that is going to be supportive for the Aussie dollar. Over in Sweden, and we had some inflation data from the Riksbank, the first numbers after their last meeting, where they cut rates and expect to cut rates twice more. These numbers looking perhaps a little bit stickier than they might have hoped. CPI on the headline year on year coming down 2 pips, so going the right way, 1 pip more than expected. But some of their other measures, their interest rate measured CPI numbers, looking a bit different year on year, actually going up a pip. They've also got a core CPIF, which stayed unchanged at 2.9%, was expected to rise to 3%. So a little bit stickiness there. Probably doesn't change their thinking about the next 2 cuts. Plenty of time to assess those thoughts, but they'll want to see a bit more progress than they got from that CPI report. We've also had some final numbers, inflation numbers from other countries in Europe as well. France, no real change over the flash numbers there, so they're coming in at 2.2 on their CPI and 2.4 on their Eurozone measure. Speaking of the Eurozone, we had some employment data as well. Again, quarterly numbers coming alongside the first revision for Q1 GDP. That all came in unchanged as per the flash number, keeping those green shoots evident. The employment change there, 0.3 and 1.0. So at least it's positive. That's something to take away from those numbers. Anyway, we've had a flood of ECB speakers coming out. You love them. ECB's Ren says if the confidence that inflation is approaching its target in a sustainable manner continues to strengthen, the restrictiveness of monetary policy can be reduced. In other words, if the data is okay, we're going to cut rates. ECB's Vilroy, we will likely start cutting rates in June. ECB's Lunch says first 50 basis points of rate cuts are close to a no-brainer. He was speaking to Handelsblatt said we should proceed gradually and refrain from committing to a second rate cut in July. Said higher rates for longer by the Fed might lead to a slower pace of ECB rate cuts. ECB's not talking during his moderated meeting with Powell yesterday. Said signs of the Eurozone recovery are clearly there, and that should accelerate in the second half of the year, and that June may be a good opportunity for a first rate cut. ECB's MOAR rate cut in June is very probable. Credit Agricole's CEO still expects 3 ECB cuts this year and expects 3 more in the first half of 2025. So we're going to be playing the how many times does the ECB cut this year game, same as we're doing with the Fed. Over to yesterday's data. The first sort of inflationary data from the US came via the PPI numbers, and it was a little bit of a messy one. On first glance, the core came in as expected 2.4%. Now that number was 2.4% the prior month, but it got revised down. So you can look at it in two ways. PPI was softer last month, which just makes this month's rise even bigger, or that this month's rise wasn't that big over last month's, even though it got revised. So pretty similar in the numbers. Overall, same thing there for headline PPI. That was revision that got revised from 2.1%. Again, another downward revision, but it came in as expected. Both those measures coming in as expected. What was a little bit hotter were these monthly numbers. The market has jumped a bit up and down on those, but as mentioned, PPI is a much more volatile beast than CPI. Overall, I called it warm yesterday. It wasn't hot. It keeps the stickiness in place for the Fed and just makes their deliberations that much harder. It's higher for longer numbers, let's call them those. We'll see whether they're reflective of the CPI data later on today. So over to Powell. He popped up at that panel or that moderated event. He pretty much talked up the economy, saying consumer spending and business investment are looking fairly strong. Said we did not expect a smooth road on inflation, and that we must be patient and let policy do its work. Expects inflation to move down back to levels more like last year. Well, if you're looking at CPI, then we're at the same levels we were at last year. Says confidence in inflation moving back down is lower than it was, and he said his confidence wasn't as high as it was before. He also mentioned that the PPI reading was actually quite mixed. He was asked if inflation would prove more persistent, and says the Fed doesn't know yet. The policy rate is restrictive. Time will tell if we are sufficiently restrictive on policy. Now, he did say that he doesn't think it's likely that the next move would be a rate hike, but he did say that it was still a small probability, which is a bit more than he's given, at least at the last FOMC. He said it's more likely that we would hold the policy rate where it is. So overall, from Powell, he didn't, as we expected before, he didn't really need to say too much. The market reaction since the FOMC is the right one as far as he's concerned. No one got overly hawkish after that FOMC. Obviously, we saw dollar yields coming off. We continue to see the dollar coming off. So that's all moving the right way, and the market is leaning the right way for him. So there was no reason to come out with any massively strong comments just to steer the market away from the wrong direction. Fed's Mester has been out saying the Fed is in a really good place to study the economy before charting the rate path. Fed Schmid says policy is in the correct place, and the Fed are prepared to be patient as inflation eases back towards 2%. Says interest rates could remain high for some time, and gave us a little heads up perhaps that the Jackson Hole Summit theme will be about the transmission of monetary policy. So how they're going to get those rate cuts feeding through to the market, that will involve obviously QT and bank reserves and all the other stuff they're doing as well. Treasury Secretary Yellen said that the new China tariffs won't cause meaningful US price hikes. That's after the US put all those tariffs on China. I didn't see her talking live, so I don't know if she said that comment with a straight face, but we'll wait and see whether it brings any price hikes or not. Fun and games in the OPEC world, OPEC Plus, or the oil world. OPEC Plus said in the latest report that nations again exceeded oil output quotas last month. No shit, Sherlock. They left their 2024 oil demand growth forecast unchanged, as with the 2025 forecast as well. And then this morning we've had the IEA saying that demand is going to be lower. And as Mark pointed out in our chat room, both talking their own book. But yeah, one says demand's going to stay unchanged, one says demand's going to come lower. So you can trade between the middle of those two quotes. That's all I have on the news front. So let's take a quick pokey at what's coming up from the data later. Obviously, CPI is going to be the main number. We do have retail sales out as well, so don't discount those. I know everyone's looking at CPI data, but you know we're going to want to know what the consumer's up to as well. But we'll start with CPI first. Obviously, the two main numbers to look at: year-on-year numbers expected. Headline expected to drop a pip to 3.4%. Core is expected to drop 2 pips to 3.6%. Headline 3.4%, core 3.6%. So those are the two main numbers you need to look at first. We're not in that situation where one matters more than the other. You know, sometimes if CPI is doing something but core is doing the other, central banks like to focus on whichever one fills their narrative. They're pretty close together, so there's no reason to take one over the other. Unless there's a big move or, you know, one goes up and one goes down. So I think for this one, the market's probably going to get selling the dollar again if we get a number that's softer than expected, even if it's by a pip. So if we see 3.3 and 3.5, that may be enough for the market to carry on selling dollars. How much more it wants to go on selling, no, is another question. So that's where the market is at the moment. You can see it on in pretty much any dollar chart you're looking at, bar, you know, even dollar yen, which is coming off at the moment. The market wants to sell the dollar. It's looking for any excuse to sell the dollar. So even a small miss on these numbers to the downside will probably get the dollar selling. And of course, look at it in grade it if you like. If it comes in, you know, a 2-point miss on either, there'll be bigger dollar selling. You know, the more it misses, the bigger the dollar selling is going to be. But on the other side, again, I don't feel like any dollar rally on stronger numbers is potentially going to last. So if we get an unchanged number or 3.7, you know, unchanged on the headline up towards 3.8, we're probably going to see a reaction, dollar buying, yields rallying, but I don't know if that's going to last too long. Again, a question of scale. You know, if we get above these numbers, these prior numbers, then that's a different kettle of fish altogether. We might see again the pendulum swinging and the market turning a bit more hawkish. So it is a question of scale. Look at how big a beat or how big a miss it is before judging what the dollar's going to do. As I say, just a small miss, the dollar's probably going to keep selling off, but I don't know how much is left in the tank. We've done a fair bit already, so we'll keep an eye on that. But then, as I said, we've got the retail sales coming in as well. Headline retail sales expected to rise 0.4%. Again, if it's on and around expectations, probably limited reaction. But we do have to add that into what the CPI is doing. So if we get soft CPI and no trees being shaken in retail sales, go with the CPI. If we get soft CPI and strong retail sales numbers, that's going to be soft landing music for the Fed. It can give them a bit more confidence that they can cut because the economy is not collapsing and inflation's going their way. So that, again, still side with dollar selling on that basis. Obviously, if it's a really, really hot number, then again, we might be looking at something different. It might just be a bit of a counter and the market won't know what to do with that exactly. In the middle of all that as well, we got the Empire State Manufacturing. First numbers for May. This one's been all over the shop of late, so don't pay too much attention though. Look at the components underneath: prices paid, employment. That's probably the most important metrics to look at initially for that report. And then a bit later on, just keep an eye on these business inventory numbers. I've spoken about these previously. Inventories, they can be a bit of an indicator for activity. Market may not move too much one way or another unless there's a big variation, but just for those of us who like to watch the fundamentals a bit closely, if we see inventories coming down, that can be an indicator that activity may be about to wane. That was one of the reasons why the GDP was a little bit on the soft side, because of an inventory drawdown, i.e. people digging into stocks rather than ordering new. So that's why we look at this inventory data. Then we've got a few bits and pieces later on as well. Housing numbers from the NHAB and these retail inventories as well. They're a final number. We already had those, the flash number with that, but just again, keep an eye on those in case they're a little bit worse. Right, so yeah, as you say, Bran, that's a lot of numbers, a lot to look at, and obviously ForexAnalytix will be keeping those an eye on those live, so you'll get the instant reaction, what we think about that data: good, bad, ugly, okay, what's it going to mean for the dollar. You need to look at that pretty quickly and decide which way it's going to go, so don't forget to join us on Face. Right, well, let me go fishing for Gregor, because he's not in as a host at the moment. Let's see where he is. If you're in, Gregor, stick your hand up, mate. There he is. Got him. Promote to panelist. Right, there you go. That's Gregor coming in. But just before he kicks off with his magic, I'll just look at a few couple of pairs, and then I'll pass it over to you, mate.
Hey, I'm here.
Yeah, you all right, mate?
Yeah, all is fine.
Cool. Right, so let's have a quick look at a couple of things, and then you can take it away, mate. So euro dollar, first one, we're just nudging up against into my zone. Still remaining fairly bullish, this one, as it has been for pretty much a month now. We've been chewing through the levels. Got my old zone here. You should all know about it. It's a big historical zone, goes back years. Just an area where the price always tends to find it a little bit sticky, trying to get through. So it can hold and mark a top several times, or if we get a breakthrough, then we might get a bit of a kick on to higher levels. So this one area you may want to look at for this CPI, can we get above it, or if we get a dip, how long is that going to last before buyers come and step into it? So that would be my favour side anyway. If the numbers are reasonably warmish, hottish, sticky-ish, and we see a bit of dollar buying, then I might look to pick up a dip. I'll probably stick to cable, which I'm in at the moment. That's nicely breaking 126. I'll have to take a little bit more profit off the table. So that's gone through. The big figure was holding it pretty closely on that one. I did show this chart this morning. If you want a bit of a cleaner look at cable, if you want to get out all the intraday noise, I know some of you traders aren't at your desk all day every day, so having this sort of chart formation, if you like. Just gives you some levels to trade on the wider ranges. We've got this 123, 127 range. Again, it's one of those ranges. If you go back in time, you can see we've always messed around in this area. It's not always been clean, but you know, sometimes when we break into it, we come up, we hit it, then we break below, then we hold below, and then you get the message. So I don't see anything from this data unless it's really super hot or super cold. I don't see anything in this data that would trouble the ranges. Maybe this inside range are only, you know, 70 pips, 80 pips from the 127 area. So over a big number, that's probably not going to stand up to much, but it's worth keeping an eye on. If we move out of this zone, then we'll be looking at the wider range, which comes in 130s, 120s, those big psychological numbers, as well as technical levels as well. So a push up there, you'd have to think, okay, enough's enough. That might be a decent stretch point. So yeah, if you don't want to get messing around in the short-term noise, just, you know, park your chairs at either edge of the range, see if you get a move, see how it goes. If we get a test there, might be an area to just play the range and counter trade or whatever's happening. That's certainly what I'll look to do if we get up there. We'll see what the data brings with that one. A lot of chewing going on. Aussie dollar. Let's come in a bit. Where should we go? Let's start there. So we've had these recent highs just along the 66.40s. It was a bit of a support area when we broke down through this period. Let's just go a tiny bit wider. That should do it. So when we were up at the high 68, 69s, we had this breakdown through this zone. Then immediately after the break, we held it. We've only tested it once, and then we've had some half-hearted attempts to get back up there. As I say, resistance recently in the 66, 40s, 50s area. We're trying to chew through it again, and then we're going to hit that zone. Again, probably pretty close if it's a really weak CPI number or even a moderately weak one. We're only 10, 15 pips away, so there's every chance that we'd bust through that zone pretty easily. But we'll have to wait and see whether we can hold that break or not. If we hold that break, then we might be pushing up 67s, maybe even if it keeps going, we get a look up towards this high point 68, 69s, which has been another solid resistance area, a bit like cable 130s. You know, that's probably going to be a decent area to look at as a bit of a stretch point for things like that. On the other side, dips, again, look at that 66, 65, 85 area, maybe even down to that 65 zone. Again, might be another one I'll look to dip by if the data goes my way or goes the way of the price without being too extreme. Gregor, I'm going to hand it over to you, mate, and then I can always grab it back with a couple more afterwards.
Yeah, sure.
You got any thoughts first off for the data today? Got any expectations yourself?
Based on, how market reacted after yesterday's PPI figures, I just think, as you said yourself, even if that would be some hot print, I just still think that sooner or later dollar will get sold further after rally. So, but if suddenly inflation comes weaker with numbers, then I think that we may immediately see acceleration to the downside. So all in all, my expectations are regarding the markets that dollar will most likely continue to weaken.
Cool, thanks, mate.
So, firstly, can you see the charts? Yes.
Yep.
Okay. So firstly, I want to look at this. I have commodity index here at the top in black. Below we have crude oil, and here in the middle we have the CPI year-on-year basis. So actually, if we look a little bit back, here in March, we have seen commodities moving strongly to the upside. Crude oil rallied more than 10% or so. It moved very close to $90 per barrel. And a few weeks later, we got these inflation numbers that came out a bit hot, right? 3.5%. And now, if we look back, what happened with crude oil and energies in April, we can see that crude oil actually dropped almost 12% or so. It's been basically trading to the downside since start of the month of April. So if we respect this kind of activity, as we know, the crude oil is very good and important indicator for inflation, and maybe we will get some cooling down here regarding inflation. So I would not be surprised if we get number below 3.4%, but even if we get around 3.4, which is expected number, would still be down for 3.5. But we can clearly see that there is definitely a sticky inflation. So we may not expect any kind of a big changes just yet here. But looking at the correlations, it's definitely there. So I would not be surprised that sooner or later we could potentially see this inflation turning possibly down towards 3%. The next important thing is now if I try to teach you a little bit of Elliott waves. Whenever I want to confirm that we have a top in place here, okay, let's say that these are the US yields. So if that was an uptrend and I want to confirm that that's a top in place, I need to see a clear impulse here in 5 waves. So only this price structure will tell me that we have a top in place and that the trend has changed from bullish to bearish mode. Firstly, if we look here now on weekly scale of the 10-year US yield, you can see that we are already testing this trend line support. We rejected the 78.6%. We even now coming back below 61.8% and now potentially trying to see a breakout for this week. Of course, these inflation figures will define if that's really the case or no. But to make sure that maybe we have, even if that would be just a temporary top here, to make sure that we will see more weakness over the next few weeks, I want to see 5 waves down here in a smaller time frame from that recent swing highs. And a closer look here shows us that I can easily count 5 waves down. Okay, so clearly here the sentiment has changed from bullish to bearish mode. So that's probably the most important structure, at least for me, to know in which the direction I should look when it comes to dollar and other assets. So these 5 waves down suggest that we will most likely continue to the downside, and I will stick to my bearish views here as long as we are trading below this high, because if that was the 5 waves down, then this is the important significant top here, right there. That should hold, that should stay in place. If this one is wrong, then of course dollar will turn back to bullish mode. But even these 5 waves down will obviously see some kind of a retracement. Markets are not moving in straight line here. So now the question is, maybe, who knows, maybe we get the inflation figures above 3.5% and US yields will rally. But from Elliott wave terms, this will be fine because we will expect only 3 wave rise before market will resume even lower, because that's how basically Elliott wave patterns work. Whenever we spot reversal in 5 waves, it means the trend has changed. But for this trend to resume, we are waiting on a new pullback that should be in 3 waves. So now the question is, will we get an extension after the report, or maybe we are going to see some spike and then price stabilization? It really will depend on the data itself. But overall, that's why I said earlier that I will be expecting weaker US dollar, even if inflation would be hot, because then I think it would be just a temporary pullback here. And I've been updating these charts for a while, even shared in our chat room for a while, and I will keep doing so in the next few days. Now, looking at crude oil here, now clearly we are here trapped in the range. So I will be expecting more weakness later this year. Maybe now we'll just try to consolidate here for a while, maybe even through summer, but eventually I will be expecting move to the downside, and that's maybe when we may start seeing some very strong move to the downside on the US yields as well, because of the lower inflation. Now, looking at the dollar itself, if the US yield has stopped, then we also have a very strong resistance in place here for dollar index. So I'm looking potential triangle. So again, it's a very big range, but maybe dollar index itself, it's not the best ticker for the overall dollar view. I mean, you have a very strong commodity currencies, pound is waking up, so it's much better bearish dollar view on some other tickers rather than the dollar index. It's most likely because of the euro, which is not doing that well. But overall, I just think that a dollar index still has a plenty of room for more weakness going into the end of this year. So after summer, I would be expecting that this thing may start accelerating. Also, here is the overlay chart. Okay, so below we have US yields, the 5 waves down that we talked about earlier. And here on the top, I have the correlated markets, the most important ones that we are tracking. And you can clearly see that silver, gold are doing quite well. Keep in mind that these metals were doing quite well. There's silver is specifically stabilized. Even when US dollar, okay, and the US yields have seen some recovery here a week back or so. So as soon as US yields and US dollar turn to the downside, metals are now just exploding, silver in particular. So I think that it's worth to keep an eye on for more potential upside on metals, especially if the yields really has seen an important significant top. Then you have stocks, obviously, also following the same pattern, the risk on mode. And looking here at currencies, Aussie commodity currencies, like Mexican peso as well, they are doing quite well. So I'm thinking about more upside on this, and we'll be definitely looking for further gains after any retracement. So if we take a look on maybe on Aussie first, before we go to the Aussie, maybe it's worth to mention that copper is doing very well. Basically, copper has been known as a very good economic indicator, positive for economy when the prices are on the rise because of the demand. You know, copper is used in a lot of sectors for production. So definitely it's worth to keep an eye and consider that if this thing is really staying in uptrend here, that Aussie could do well. Hang Seng Index, I shared this in Face a few times. We broke this head and shoulder bottom formation, the neckline, and it looks like that we are in a very strong recovery. So it's not surprised that Aussie is coming to the upside, not really accelerating as I would expect normally. But I think that maybe this will change if inflation really soften today. So looking at this price action, Elliott wave terms, I will try to keep it very simple. I will not just complicate here. So that was a very strong move, and you have a contra trend movement in 3 waves. And now you have a broken trend line here, which has been actually retested from the outside of this channel. So I'm thinking about more upside. Definitely some resistance here should be important. That could potentially cause some setbacks, but eventually if we see a new pullback, I think that this will be the buy a dip scenario here. So if we see a retracement, I just will be fan of the longs here on the Aussie. If we take a look on cable, now cable is also making some very nice recovery. Notice that we are recovering after this strong drop, which by the way has unfolded in 3 waves. So if you recall what I said earlier, if you see 5 waves down, that means that the top is in place and the trend is changing. But if you see 3 waves down, that's a correction, okay? Because it's a not strong one directional movement. And we are already seeing very strong reversal out of this downward channel. So I'm thinking about more upside. It could potentially still price stay in this potential triangle range, but at least the upper side of the range, let's say firstly 1 to 730, 1 to 8 could be the next objection here. Also, if we take a look here on the euro pound is trading still within this very big nasty range, but whenever that's the case, at least we should focus on basics. And since we reversed at the upper side, very close to 61.8%, I just think that there is a chance that we will still see a movement to the lower side of this range. And this could potentially tells us that if you maybe are dollar bear, which currency you should pick or which pair you should trade, especially if we consider that ECB somehow is favoring the cuts already before summer, then definitely this is something that would keep euro under pressure here. So looking at the overall picture, I still think that pound is looking quite well at the moment. Looking at the gold metals, gold it's been a little bit weaker compared to silver, but even this one shows potentially correction here on the way up. Maybe here it's a better visualization. I mean, you had these corrections on the way up. So why calling this a top? I think that that's not a good idea. It's better to stick with the trend. Of course, this could always continue sideways for a longer period than we think. But the important is that gold metals been doing very well despite higher US yields. And now when we have this reversal on the US yields, this makes me think that metals will stay in uptrend. And maybe silver is the one that will try to outperform. I have gold silver ratio down here. You can see that we are now testing the lower side of this potential range. So if we're really trying to break this out, then I think that silver could be a real mover. And overall, this should be bullish, at least temporary, for metals. Now, final markets maybe worth to check. Nasdaq 100, some very nice pullbacks, consolidations. I think way forward that new highs can be coming. Also looking at the S&P 500 as well, very similar consolidations here on the way up. The only question is if we'll get maybe a touch of new high and then a pullback, or we will see a straight move to new high for a wave 5. I just realized that sometimes corrections can be a bit tricky. You will see one correction very sharp and deep. The second one could be a little bit more sideways. So something like this is definitely not out of the table yet. But at least in the short term, I would not be surprised actually if we see new highs here, especially if inflation would be really cooling down then today. Then we know that traders will be aggressively start buying equities, and we could easily be trading much higher. Looks like that Powell yesterday also somehow hinted that they are not looking for any kind of a hikes. So this is something that keeps this market alive. Looking maybe the final one for today is German DAX. We've been talking about bullish structure on German DAX. I've been tracking this correction. It's very interesting how this escalation in the Middle East weeks one back caused this fear, the sell-off, and then everyone expected what will happen. But usually market will very quickly get used to this kind of a news and will try to focus on positive news. And what we are seeing right now, it's definitely looking very good. At least at this stage, could easily extend towards 19,000 because if you look at these substructures for a wave 5, well, that's a motive wave. It should be structured by 5 waves. So I think that there can be room for more upside. We have seen some pullbacks in the past few days, very close to the previous swing highs, which reacted as a support very nicely. So I think that that's at least for the short term, it's quite very important for this trend to be alive here. So if anyone has any questions, that's it for me. This is what I prepared for today.
Thank you very much, mate. Yeah, if you have any questions for Gregor, then yeah, just pop in the chat there. We can have a look at it. I'll grab the screen back quickly, mate. Because just for those who aren't aware, as Gregor said, he does all our wave analysis on our platform on the dashboard there. If you hit the Elliott Wave tab there, you can get all his analysis updated and then just change the tickers on the side there. as well as all the other analysis that we do. And if you want to also check out Gregor, he's one of our coaches on our Trader Coach program, and you can check him out there. I'll stick the link in. Oh, come on, there we go. I'll stick the link up in the chat for you there, so you can check out what he does if you're interested in learning a bit more about Elliott wave analysis and how to use it. He's given us a quick lesson in what he sees difference between trend changes and just corrections, so you can have a look there. But yeah, for any questions up in the chat, and Gregor will hang around to answer those as well. So yeah, copper. This is one I want to take a quick look at. We did have a quick look at it yesterday on Face. Looking very, very strong here. But this is another one of those commodities that's rocketing higher, but I'm not sure it's demand. There's a lot of stories going around about a shortage in copper markets. So it seems that potentially buyers are coming in and then just taking it, ramping it higher. Users, producers, that sort of thing, are looking to, be long rather than short. We get, as I said, we get the usual stories that this is a short squeeze, but when you're breaking above highs, that to me, that's not short skin squeeze. That's longs coming in and taking it higher. I know there's some commentary as well we've had in our chat room about speculative positions via the CFTC stuff. But again, as Mark pointed out, the LME is your bigger market for copper over the COMEX stuff. So, yeah, we're getting a squeeze up here. Keep an eye on the Aussie dollar as well for this one, because it's obviously a closely related commodity currency to copper. It's probably one of the reasons why we're seeing a little bit of a tailwind in the Aussie as well. So factor that in. If we do get strong CPI, Aussie may be one that doesn't pull back as much as the others, based on what's happening in copper, because obviously, as I say, it keeps that momentum going, and obviously with gold still, keeping up on the high side, that's also going to be another input for the Aussie dollar as to why it may not suffer as many of the rest on US dollar strength, at least. Right, well, that's got us through today anyway. You should all be set up for the CPI later. You should know what's what. None of it should be a surprise now. I hope it's not a surprise now. If you're in our chat room, you're still unsure what to make of the CPI, how to trade it, what to look for, then just pop a line in there, ask a question, and if not myself, someone will help you out with that one. Thanks again, Gregor, for all your stuff, mate. Much appreciated. K-Man should be back tomorrow, I think. So we're back to relative normality. Have a great trading day, everybody. Trade safe, and we'll see you all tomorrow. Thanks a lot.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.